anyone looking to build wealth by investing into the stock market, the S&P 500 is among the best option for you as it provides great diversification, which reduces the risk on your hard-earned money, and it has historically proven to do very well over time for investors. In fact, there's a reason why one of the best investors of all time, Warren Buffett, said that for most people, the best thing to do is own the S&P 500 index fund. Because of that, I'm about to go over what the S&P 500 is, why to consider it, how it compares to other investments in the market, and why I believe it is among the best stock market investment of all time. So to get straight to it, let's first go over what is the S&P 500. Because there's so much history behind this index, to sum it up, the S&P 500 stands for the company Standard & Poor's that roots all the way back to the 1860s and is a combination of two companies. The standard comes from the company Standard Statistics Bureau that was founded in 1906, which published financial data on companies. Where the name Poor's came from Poor's Publishing, which was a publisher of railroad industry guidebooks that was officially founded in 1868. These two companies merged in 1941 to create the Standard & Poor's Company, which is now seen as the Standard & Poor's Global. But as far as the index, the S&P 500 is a market cap weighted index that contains 500 leading publicly traded companies in the US. When you hear market cap weighted, all this means is that the companies that are listed inside of the S&P 500 are given weight based on their size, which is why Apple has the largest weight in the fund at 7.06%, and then following that are other companies you probably heard of like Nvidia, Microsoft, and Amazon. But in order for companies to qualify for this index, they must meet specific criteria. And also know that the S&P 500 rebalances the companies in the index every quarter, which is every 3 months, so as time goes on, they're able to adjust with the market. As you can see, the top two companies in 1990 were IBM and ExxonMobil, where in 2024, technology has taken over with the top two being Apple and Nvidia. But what's really important to understand here is that this index is managed by the Standard & Poor's Dow Jones Indices, which is a division of the S&P Global Company. I mention this because in order to actually buy an index like the S&P 500, you need to buy a fund that tracks the index, hence the name index fund. So if we look back at how I showed the percentages of each of the companies inside of the S&P 500, scrolling up on this page, I actually used the information from Vanguard's S&P 500 ETF with the ticker VOO. And understand that index funds can be bought as an ETF or a mutual fund, which if you click the direct link here, you can see the mutual fund version of the S&P 500 through Vanguard, that is VFIAX. So besides Vanguard's S&P 500 ETF VOO, understand that there are other options available from other issuers that you could potentially invest into, such as BlackRock's IVV, Spider's SPLG, or SPY that is great when trading options. And for mutual funds, Vanguard has VFIAX, Fidelity has FXAIX, a zero-fee version FNILX, and Charles Schwab has SWPPX. But as far as Vanguard's S&P 500 ETF, you can purchase this on nearly any investment platform, and by doing so, you are able to gain exposure to 500 of the largest US-based companies all within one purchase. And of the 500 companies that you would now own, these are the top 10 holdings, and if you add them up, they make up roughly 35% of the entire fund, which you can also see that 31.3% of the entire fund consists of the infotech sector, with the ones following being financials, consumer discretionary, and healthcare. So knowing that, here is exactly why to invest in the S&P 500. For starters, understand that investing into index funds alone typically comes at a low cost because they are passively managed, which means there's no fund manager that's actively taking the time to research and pick stocks that are inside of the fund. Because of that, using Vanguard's VOO as the example, they currently have a 0.03% expense ratio, which is the total cost it will take to own the fund per year and will be taken out of your investment automatically over time. It's not something you're going to have to pay separately. So to sum it up, let's say that you have $10,000 invested in the S&P 500 VOO. That means that you would pay $3 per year in fees. And because the past 10-year performance for the S&P 500 has averaged a 13.06% annual return, the fees are so small you wouldn't even notice them. And if we look even further into the data, the S&P 500 has grown about 10.5% annually since 1957. So if you believe the US economy is going to continue developing over time, then so will your investment. So let's say that you have $1,000 and you start investing $500 per month into the S&P 500, averaging 10% per year, and you do this for 30 years. That means you would have nearly $1 million And if it were a Roth IRA, that would be completely tax-free at retirement. And not just that, but throughout all of the years of investing, the total cost would have only been $5,700. May sound like a lot, but if you instead invested into an actively managed fund that may range from 0.5% to 1% of an expense ratio, using the same scenario, your investment instead would have grown to $871,000, which is much less because you would have paid $133,000 in fees throughout the time of owning the fund. So just like that, using a tax-advantaged account like the Roth IRA and low-cost index funds like the S&P 500, you could easily save tens to hundreds of thousands of dollars from fees and taxes, which will only improve the odds to become financially free one day, and is why I create the content I do. As a whole, buying or selling the S&P 500 is super easy to do. You have way less risk than buying individual companies, and you can easily set up a plan to auto-invest into it over time, which should only improve your confidence to actually build wealth over time. Knowing that, before moving on, I'd like to thank the sponsor of this video, Moomoo, which is a free investing platform where you can invest into stocks, ETFs, and even options on their platform. Currently, they are running a promotion where you can earn an 8.1% APY on your uninvested cash for a limited time as a new user, where the platform has many features you can benefit from, such as getting access to stock analysts on the go, getting real-time alerts, ratings for particular stocks, target prices, and latest changes that are just a few tools they offer. And not to mention, but they also provide indicator sentiment to see whether a particular investment is currently ranked as bullish or bearish. And instead of needing to pay the full share price, you could instead use fractional shares that allow you to buy any amount you desire that is at least above $5. And if you want to boost your trading experience even more, you can check out their desktop platform where you can customize many charts and other tools all within one place. Also know that there are no trading commissions or contract fees on equity options, plus you get an insane amount of data and news to help you advance your investing knowledge. The platform has all sorts of financial tools, whether that be dividends, historical earnings, or any sort of data that you can think of on the go. So to get started with Moomoo, click the link in the description below where you can get up to 30 free stocks after making a qualified deposit. With that said, let's now go over the S&P 500 versus top competitors. For starters, understand that the two most popular stock market indexes besides the S&P 500 is the Dow Jones Industrial Average and the Nasdaq Composite. When it comes to the Dow Jones, I'm going to reference the Spider Dow Jones ETF with the ticker DIA that first off has a higher expense ratio of 0.16%. But as far as the index, it is composed of 30 blue chip stocks, which means they are among the largest, most established companies in the market. And right here, you can see the top 10 holdings that are inside of this fund, where the top ones consist of Goldman Sachs and Microsoft. But understand that the Dow Jones is a unique index because it is actually price weighted, which means the companies that are inside of the fund are given weight based on their stock's price. For example, Goldman Sachs has the largest weight in the entire fund, and its current share price is $562 per share, where Microsoft is the third and trades at $417. So besides that, the top sectors that are inside of this fund include financials, infotech, and then healthcare. And fun fact, in 1896, the Dow Jones was the first index of stock market activity. So knowing that, if we look at the performance of the Dow compared to the S&P 500 over the past 10 years, you can see the average annual return for the Dow Jones was 11.41% per year, where the S&P 500 was 13.07%. But with the idea of established companies, the worst year for the Dow was down 7%, where the S&P 500 was down 18%. But let's now go over the Nasdaq Composite. So the Nasdaq Composite is a market cap weighted index that is over 3,000 stocks that are all listed on the Nasdaq Stock Exchange, which is heavily weighted by tech stocks. Currently, there are no funds that track the entire index, but there are two popular alternatives that you may be interested to learn more about, with the first one being the Fidelity Nasdaq Composite ETF with the ticker 1Q. So this fund also has a higher expense ratio at 0.21%, and rather than the entire Nasdaq, the fund currently has 889 holdings, with the top ones being Apple, Nvidia, and Microsoft, similar to the S&P 500, but now they have much more weight to the fund, being 10 to 12% each. And crazy enough, if we add up the top 10 holdings, they make up nearly 61% of the entire fund. And you can see that Infotech covers nearly half of the entire fund. But with many of the tech companies that have grown significantly recently, the fund has achieved higher returns over the past 10 years, where it has averaged a 16.27% annual return, where the S&P 500's was 13. then the worst year for Fidelity's 1Q was down 32%, where the S&P 500 was 18. So this pretty much just shows that if you are willing to take on the risk, you could get better returns over time with 1Q rather than the S&P 500. So besides the ETF 1Q, another NASDAQ index fund that is among the most popular one is Invesco's QQQ. Now QQQ tracks the NASDAQ 100 index, which specifically means the top 100 largest non-financial companies traded on the NASDAQ, where the top 10 companies here make up 52% of the entire fund. And also know that the infotech sector alone makes up nearly 60% of the entire fund. But true fact, QQQ has beaten the S&P 500 7 out of the last 10 years. QQQ has averaged an annual return of 18.26%, being the highest of all the ones mentioned, but the worst year was also down 32%, compared to the S&P 500 at down 18%. So to prevent this video from being super long, understand that there are many more stock market investments out there, where a few other popular indexes would be the S&P 100, S&P 400, Russell 1000, Russell 2000, Russell 3000, CRSP US Total Market, and the S&P Total Market Index that are widely used. But of all the options, is the S&P 500 truly the best overall stock market investment of all time? First off, understand that the choice is completely up to you. You may think a certain stock or aggressive fund is the best way to go, but what is the overall risk that's involved? Would that truly be the single best investment that you could have as the foundation to a portfolio? Of course, the choice comes down to what type of exposure and overall risk you are personally looking for, but remember, not everyone will agree, and that is the point of personal finance in making your own investment decisions. But as far as the options I mentioned, if you are looking to be more stable, the Dow may be a favorable option. Or if you're looking to invest heavily in technology for that potential growth, you may want to consider a NASDAQ ETF like the ones I previously mentioned. But remember that you can combine any index funds however you like into a portfolio. But all in all, because the S&P 500 provides broad diversification, a solid balance between risk and reward, it is also among the cheapest that you could own, has historically proven to build and secure wealth for many investors, and is also considered the benchmark to the US stock market. Because of that, I personally believe that the S&P 500 provides the ultimate balance, making it the overall best choice as the foundation to many investors' portfolios. And if Warren Buffett is saying that after he dies, 90% of his wife's inheritance will go into the S&P 500, I think I'll take my chances. With that said, if you want to learn more about investing into the stock market, I highly recommend you check out the videos I've created on this channel, which I'll have some of the most relevant ones linked in the description below. Which while you're at it, I've created many free learning guides that I think you'll greatly benefit from. And if you're interested to see exactly how I allocate each of my investments and other exclusive content, consider checking out my Patreon linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.